Hey everybody, welcome back to Mr. Money Sense TV, the channel where we help you earn more, keep more, and grow more money. In this video, we're going to talk about a very common thing that affects a lot of people, but people really don't have much knowledge into the inner workings. And that's, what is a FICO credit score? So I'm sure you've heard that term, that either FICO or credit score or something of that nature, but you may not necessarily know what the inner workings of a credit score are, how it affects your life, and how to basically manage your credit score. And yet, this number can really drastically affect your financial life, where it can cost you, especially when it comes to like a mortgage, if you have a bad credit score, it can cost you hundreds of thousands of dollars over the course of your life. So it's a really important number to know and to understand and know how to work. So that's exactly what we're going to go through in this video, is giving you a little background onto what the FICO credit score is and how to use it to your advantage. First off, a credit score is actually just a generic term for some sort of credit reporting number. Where FICO comes from is FICO was actually kind of the first credit score that came out. They were the first ones to try to put your credit history and your responsibleness when it comes to money into a tangible number for banks to understand. And so FICO was actually developed by the Fair Isaacs Corporation back in the 80s, and since then has kind of become the gold standard when it comes to credit scores. And how that FICO credit score works is it's actually a score out of a score between 300 is the very bottom, that's a bad score, 850 is the top score. So anywhere between 300 and 850 is a score that you can get with a FICO credit score. Where that number comes from is it's basically an aggregation of your credit history reported through the credit bureaus, and then the Fair Isaac Corporation, or now just the FICO score, basically goes through and takes your credit history and then has a specific algorithm that they mix it around, break it down, and then determine, okay, based on all this data, here's where your credit score is. So why do credit scores exist in the first place? So to kind of explain this, I'll go through an example. So if I'm a bank and you're coming to me asking for money, well, you're just a random person on the internet right now, so how do I know that my money is safe in your hands and that I'm going to see that money come back to me? Well, the way to do that is to have a kind of standardized score where I know how responsible you are versus the rest of the potential borrowers out there. So that's where that credit score comes in handy. So that way, if you come to me and ask for money, I can look you up and see, like, oh, this person has an 800 credit score. I know they're a very responsible borrower, so I'm more than happy to lend money to you. And in exchange, because you're a responsible borrower, I'm not taking as much risk as a bank, so therefore I'm going to give you a lower interest rate. Whereas if you came to me and said, here's my 500 credit score, I'm going to see a lot of risk. I may still lend you money, but because I know that there's a chance my money might not come back to me, I'm going to charge you a higher interest rate in the meantime. And that amount of interest difference can be drastic depending on what your score difference is between a good borrower and a bad borrower. So having a good credit score, again, is going to be incredibly important to making sure banks are willing to look at you for lending money, but also to show how responsible you are. But that's why a bank would use a credit score. It's really just to, they don't know you, and it's really just to determine what kind of borrower are you? Are you someone responsible that they can entrust their money with? So where do banks get these credit scores from? So there's actually three main institution of bureaus, or credit bureaus as they're called, that generate those credit scores for the banks so that they know what your score is. And I'm sure you've heard the name of these institutions, but they're Equifax, Experian, and TransUnion. So those are the three big players when it comes to generating credit reports for banks. Usually banks will use one specific credit score. They may use an aggregation of several credit bureaus, but more often than not, they're using kind of one of those credit bureaus to generate that score. So in between the different credit bureaus, your credit score may differ depending on exactly which algorithm they're using to generate your credit score. So again, there's a lot of different algorithms out there. FICO tends to be the gold standard, but but they don't have to use that. So there's a lot of different algorithms, so they can change from credit bureau to credit bureau. And what's nice about these credit bureaus is, as an American citizen, you're actually allowed to get your free credit report from those credit bureaus at least once a year. There's a lot of other institutions and ways that you can get your credit score in between, but what's nice is at least you can get them directly from the same place that the banks are getting them from once a year, so you can constantly be monitoring exactly how you're doing when it comes to your credit score. So speaking of monitoring your credit score, let's take a look at the different ways or the different breakdown of how a credit score is created so that you can use that to have a really good understanding of why your credit score is the way it is currently and what you can do to improve it. The biggest section of the credit score, and it's factored at about 35% of your overall credit score, is your payment history. So, again, me as a bank, I want to know that you're responsible in terms of paying me back on time on a regular basis. So if I see that you have a long history of making on-time payments in full, no missed payments, no errors, nothing like that, then I'm going to reward you with a higher credit score because you're able to make those on-time payments and you have a history proving that. So again, the history of payments represents about 35% of your credit score. The amount you owe makes up about 30% of your credit score. So if you think about it this way, if I'm a bank and I see that you're borrowing money from a lot of other banks and you're borrowing more and more and more money, well, to me, that signals that potentially you may not be able to pay back all the money you're borrowing, or maybe you're borrowing more and more money because you're in kind of a desperate situation. Well, if I see you borrowing more and more money, that means your credit score is probably going to get dinged. And if you have like kind of a low amount that you're borrowing or a reasonable amount that you're borrowing compared to your income, that's going to reflect well on your credit score because you can obviously pay that back if your income's good. And also, if you're not borrowing too much, it doesn't necessarily look like you're stressed or not going to be able to make those payments. There is one nuance when it comes to how much credit you're using, and that's a credit utilization score. And this is where it gets a little tricky. So credit utilization, credit card companies and for credit score purposes, they want to see that you're using basically 25% or less of your available credit. So for example, if you have a credit card with $10,000 that's available on that credit card, they want to see you're only using $2,500 or less. And where it gets tricky is that, so for example, it doesn't matter how much credit you have on that card. For example, you could have that $10,000 credit card and you could also have a $1,000 credit card. If you have $500 or a 50% credit utilization on that $1,000 card, that reflects worse on you than having $4,000 out on a $10,000 card that's at 40% credit utilization. Even though you have more money outstanding, they only want to base it off of what your actual credit utilization percentage is on that card. So you really want to be careful when it comes to the different balances because it doesn't necessarily matter the amount that you have out. It's all about the percentage of your overall available credit are you using. So if the higher that percentage, the worse it is or the more you're dinged on your credit score. Another factor is your length of credit history. So similar to just your credit history in general, banks want to see that you've been a responsible borrower for a long time. So having a longer history of credit, that ultimately benefits you. And that length of credit history factors in about 15% of your overall credit score. So the longer you have credit cards open or things like that, or say you've had a mortgage for a long time or whatever the case may be, that length of credit history really benefits you. So for example, and that's why you may be told not to close old credit cards, because if you have an old credit card that has a long history associated with it, well, if you close it, you lose that long history. So maintaining that long history is going to be important towards maintaining a good credit score. Another factor of your credit score is the credit mix that you have. So this may seem weird or counterintuitive, but a lot of the credit bureaus want to see that you have responsible payments when it comes to several different types of loans, not just credit cards, for example. They want to see auto loans, mortgages, credit cards. They want to see a mixture of several different types of debt because that shows that you can be responsible regardless of what the scenario is, whether it's low interest rate, high interest rate, etc. So maintaining a mix of different available credits can be really valuable when it comes to benefiting your credit score. The final component of your credit score is how many new applications for credit have you put in recently. So again, if I'm a bank and I see that you're doing credit application after credit application after credit application, to me that signals that you have a strong need for credit, aka you may be in desperate times or desperate situation, so therefore I'm a little more anxious to lend you money. So that's why if you're applying for credit, a lot of times you'll see that credit score drop because, again, that's a red flag to banks. So that represents about 10% of your credit score. So you want to be careful with how often you're having your credit score checked. And an easy way to do this is anytime you, for example, are looking at a loan or potentially renting a new apartment or whatever the case may be, there are sometimes what are called soft credit checks, which can check your credit but not affect your credit score, and there's hard credit checks. So every time before you apply for any sort of credit or someone wants to check your credit score, make sure you know whether it's going to be a hard credit pull or a soft credit pull. And you want to avoid having too many hard credit pulls, especially in a tight time frame. If you have like one or two, a quarter or a couple times a year, something like that, it's not going to be a huge difference, but it can definitely impact your credit score. So you just want to keep a close eye and understand, how many credit applications you're putting in, and just be very diligent about keeping those to a minimum. Now that we've gone over how to understand your credit score and what the different components are of it, let's understand where you can monitor it. So like I mentioned before, you can actually go to any of the individual credit bureaus and get your free credit report once a year, or you can go to myfreecreditreport.com and get your credit report. But what I'll also do is there's a lot of other third-party services that can help you monitor your credit, and I'll link to those down below so that you have them as a resource. Any of these services, often some will do it for free, some will do it more proactively for a fee. It just kind of depends on the service, and also depends on what things you want included with monitoring your credit score. Like some may have, for example, fraud prevention. And if you have like a credit card stolen, you'll get alerts to know that your credit score may be affected. So I'll link again to those in the show notes below, but feel free to take a look at those different options and understand what you can do to monitor your credit score. Is there something that you're struggling with when it comes to your credit score? If so, make sure you leave a question or comment below. We'll be happy to answer any questions that you may be struggling with. If you found this video useful, make sure you hit that like button and also subscribe to our channel so that way you can get updated with more tips and tricks on how to earn more, keep more, and grow more money. Cheers.